Hi, Gary here. You know, there's this individual, this judge who was in the Circuit Court of New York State back in the 1930s and 40s named the Honorable Learned Hand, name you won't forget. Now, he was kind of a philosopher, and one of the things he would say is there are two tax systems in the United States, one for the informed and one for the uninformed. And I never forgot this about taxes. Now, you're probably seeing your accountant right now, or you will be within the next week or two, and hopefully you have good news. But you know, for many of us, no one really wants to pay more than their fair share of taxes, i.e. what the Honorable Learned Hand has said about that. So how do you make sure that you're paying your fair share? Well, number one, remember when you see your accountant right now, you're asking him or her to be an historian. You're basically saying, tell me the history for last year, let's report it to the IRS, and then send the appropriate taxes if necessary, along with our withholding. And that's what you're doing. But to be a futurist means to take a look at, as an example, 2014. Now, I'm not going to talk about long-term tax planning where you might look out, 10, 20, 30 years and do things structurally within your estate to have very good tax planning. I want to talk more about specifically for, say, 2014. What would you do? Well, first of all, when you go see your accountant, ask him or her if they can see anything obvious right now, but most likely they're going to be pretty busy, and you might want to make an appointment after April 15th to sit down with them to get more proactive about your situation. Let me just give you one little tip. It's something we've been noticing for the last several years and have been utilizing quite successfully for our clients, just to give an idea of some things that are out there. Now, if you're a retiree and you're not age 70 and a half yet, you don't have to make mandatory distributions from IRAs or qualified retirement plans. You say, well, why is that important? Well, usually in those years of the 60s, you have lower taxable income. So as an example, if your taxable income is under $73,800 in 2014, it means you're in the 15%, 10%, or even the 0% tax bracket. You say, well, why is that important? Well, there's an interesting thing going on here. There's a code section that basically says that if you have capital gains that's in the 0, 10, or 15% bracket, i.e. under $73,800 of taxable income, it's 0% for purposes of federal income tax. Now, that can be a rather substantial savings, but it requires you to do something to, say, generate the capital gains tax in 2014 to pay no tax on it. Why? Because later on, when those stocks or other assets are sold and generate capital gains tax, you could be paying the 15, 20% bracket, and it costs you more in taxation. So you're being a little proactive here to get your money back at zero tax, at least at the federal level. Now, if that's confusing to you, hopefully not, but there are many, many other deductions and credits on the business side, on the personal side, and it goes on and on and on. And my suggestion to you is to sit down with your advisors, be they your accountant or tax attorney, could be a financial advisor, could be whoever your primary advisor is, to really look every year at what you can take advantage of in that code section each year to reduce your taxes, because that is the number 2 concern most Americans have about their wealth. Number 1 being they want to protect their assets, but number 2 is mitigation of taxes. Extremely important to be able to make sure they can reduce their taxation. So when you're talking to your accountant, think about that and be real proactive before the end of the year so the history next year looks a lot nicer. Until next time, enjoy.